What's up everyone, it's Karthik with MoneyVest. So I'm actually visiting my family in Kolkata right now. I took the red eye from Dubai to Kolkata last night. It was actually a pretty brutal flight, and it was kind of like a last minute plan because I wanted to surprise my family. And it actually went really well because we had an event for my nephew. It was the first time he was actually eating solid food. So we had over 150 people, all friends and family, here in Kolkata for that occasion. And I already mentioned to my family that I'm going to be in Dubai working. I won't be able to make it, and then I ended up at the last second surprising them. So that went really well, and super grateful and blessed to be here. So that's why you may find a little bit of a change in the background. I'm flying back to Dubai tomorrow, and I'll be back for the market open, and of course for another week in the market, which is going to be inflation week. So we've got very important CPI numbers coming out next week. That's exactly what we're going to discuss in this video. Make sure that you drop a like and subscribe to the channel if you're just joining us for the first time. I would really appreciate that. And links to our Discord and Patreon is going to be down below. There is a 16% annual discount that's available, and you can access pretty much all the content, all the members only private videos. Everything's going to be available. And please do me a favor and also share this video with your friends and family and other traders and investors that can prepare for the upcoming week, as last week was pretty brutal, with the S&P 500 erasing over $2.2 trillion in market cap in the first week of September. As I'm sure you already know, we did several updates and videos on this, and last week was nothing short of just aggressive selling pressure and a lot of weakness in the market, marking off the biggest weekly sell-off since March of 2023. So risk-off sentiment is in full swing. Utilities, staples, the bond market, and even gold, those are some of the asset classes and sectors that are getting a lot of liquidity inflows. But S&P 500 on an aggregate basis, more specifically led by technology, is seeing significant losses as September seasonality is in full swing. So S&P 500 suffers of worst week since height of the regional bank crisis in March of 2023. And crypto also seeing massive outflows of over $600 million. So definitely this is a very risk-off environment in the market as we start to see a positioning of being very defensive, right, in anticipation of what could be another mild to maybe a bit of a severe recession in the US. Of course, nobody knows whether we are in a recession, whether we're going to be in a recession, how long that's going to be for, and how severe the markets could sell off. That's why I think it's really important for everyone to be prepared, regardless of whether we are in a recession or not. It's really critical that everyone follows a nice liquidity framework, something that I have discussed in my previous updates, and be ready for when the opportunities present themselves in front of you. Let the prices come to you, and when they do, you can take advantage of those deals. Now, I also discussed the modified McKelvey recession indicator, which is a combination of both the unemployment rate as well as the job vacancy rate. We're now at 0.54%, and every time we've kind of breached that trigger level of 0.5, we have seen a recession. 100% of the times there's not been any false positives or false negatives in the last 80 years, 70 years actually. So we're going back as far as 1953. And every time we've seen this take place, a recession has followed with a lag time of about 2 to 3 months on average, right? So definitely make sure that you do check out a couple updates I want to highlight for you. The first one is this one. It goes into a lot more detail. That's the 100% recession signal flashing and firing off right now. And then also going over the liquidity framework, which I think is very important for everyone to be prepared for. And the second video is going to be the technical update, which is going over to the MoneyVest index and the market breadth, and very important test between the bulls and the bears and what levels the markets need to hold up in order for us to find some stability and some exhaustion of the selling pressure. If we continue to break down certain support levels, then I think situation can get much worse. But definitely do check out these videos, because this is going to be a little bit of a macro update, and then this is going to be a technical update going over the technical analysis on Magnificent 7 as well as the S&P 500 and the NASDAQ. Now, first things first, let's talk a little bit about what's coming up. We've got the FOMC meeting in 10 days, right? So we already know the Federal Reserve is going to be telling us a little bit more about the first interest rate cut, right? It's pretty much priced in right now. If you come over to the expectations, a 70% probability that the Federal Reserve is going to be cutting interest rates for the first time in over 2 years, and the start's going to be 25 basis points, and then the market's pricing in for a 50, another 50, and then 25, all the way down to as low as 2.75 and 3% by the time September 2025 rolls around. But a lot of that, as we already know, depends on economic factors such as inflation, such as unemployment, such as GDP growth. And so far, we've seen the labor market continue to be strong. However, there are some underlying factors that are suggesting for some weakness in the overall labor market. Now, going into next week, so this is going to be the calendar, starting with Monday, September 9th. We do have the consumer credit, the Atlanta Fed GDP numbers for the third quarter, and one-year consumer inflation expectations coming out. We have the 3-year note auction on Tuesday, as well as the API weekly crude oil stock, and Wednesday is the big day. So make sure that you mark this on your calendar. September 11th is going to be that day where CPI comes out, which is going to be a market moving event for sure. We've got core CPI month over month at 0.2%. CPI year over year 2.6%. That's actually going to be a pretty big deceleration from 2.9 coming down to 2.6, and month over month headline expected to increase by 0.2% as well. So we are expecting a 0.2% month over month change. However, year over year, that number is expected to hit a new low, something that we haven't seen in a very long time. So if you come over to CPI here, you'll notice that we have been kind of flirting with the 3 to 3.5% level for a really long time. I mean, very briefly, we came down to 2.9 as of last report, but 2.6 is actually going to be the lowest level that we have seen since March of 2021. So in well over 3 years, that's going to be the level that inflation is going to be coming down to. That's at least what the expectation is. Of course, if we come in at 2.7 or 2.8 or 2.9 or worse, a 3, 3.1, 3.2, if inflation starts to accelerate back higher, that obviously is not going to be great news for the market at all. And well, in a sense, it's going to put the Federal Reserve in a very, very difficult spot because you've got a lot of indicators flashing for the economic weakness, right? So although jobs report coming in strong, but there's still a lot of indicators and signals suggesting for a weakening economic condition. And then at the same time, if inflation starts to reaccelerate back higher, that is going to be the worst. I mean, that's the last thing the Federal Reserve really wants to see right now is a reacceleration in inflation, right? So they really want to see some consolidation, if anything, for these numbers to come down, and 2.6% is going to be that consensus. Now, I do want to point out to the very fact that just because the year over year reading is coming down, as consumers, I really want to help everyone understand that inflation in general is still trending upwards, meaning that we're still seeing the prices of goods and services increase, right? Even though we're seeing inflation come down from about 9%, right? So from highs of 9.1 down to 2.9 and as low as 2.6% as of the next week's report. But I really want everyone to understand that don't get sort of disguised by this decrease in inflation, because when in fact this is not a decrease in prices, it is the decrease in the rate of increase in inflation, right? So it's really just disinflation. And if you come take a look at the overall goods and services, the prices of those basket of goods and services, they have continued to increase. And that index basically went from 261 back in January of 21. So last 3 years, we've seen prices absolutely explode. And now it's sitting at well over 314. So we've seen the prices, the basket of goods and services continue to increase. Yes, the growth rate at which we're increasing year over year is trending lower. And that's really what's called CPI, Consumer Price Index, on a headline year over year basis. And that's really what the market really cares about. And 2.6% is going to be those expectations. I also want to point out to the fact that Trueflation right now has inflation, the real inflation, pegged at 1.25%, so way below the Fed's target, and the U.S. government reported number is at 2.9% right now, according to their estimates. And a couple more things I want to break down is the rents. And if you come over to the September 2024 report, the national report for the rents, they essentially captured, and this is from apartmentlist.com, captured that on average rent decreased by 0.1% in August. We have seen consistent declines. I mean, although some months have been negative, some months have been positive, but we have seen in general significant declines in rents, which are still yet to be reported in the actual inflation report. Because if you come over to essentially housing over here, so if you come over to what was that number? Food away from home. No, so if you come over to that report, let me just go over that. There we go. So shelter prices, right? So shelter cost is still up 0.4% in July, and it's 5.1% higher on a year-over-year basis. 0.2% in June, 0.4% in May, 0.4% in April, 0.4% in March. So really, shelter prices, which makes up almost a third of inflation, is also keeping inflation elevated. It is not really seeing that significant decrease or disinflation that we were expected to see, coming down to closer to 2% or lower than 2%, which is the Fed's target. So 10-year note auction also taking place on the very same day on Wednesday, September 11th. 3.96% was the previous awarded yield. And as we have a CPI week, we've also got a PPI week, which is going to be raw materials and wholesale prices, and core PPI month over month also at 0.2%, and month over month headline PPI also at 0.2% expected to come out, as well as the consumer sentiment, the Michigan surveys, expectations for 5-year inflation. We got import-export prices. All those things are going to be scheduled to also be released on Friday, September 13th. But the big week is going to be all dependent on inflation. And the reason why these events are becoming more and more important is because the market's sensitivity to these events is also increasing. So implied moves ahead of major macro events have started to pick up again as volatility has risen at the margin. And what we have witnessed is, again, if you take a look at 2022, when we were witnessing the bear market in the S&P 500, the sensitivity to these macro events was very high. I mean, in other words, the implied move in the S&P 500 was much higher based on what type of numbers we got on the non-farm payrolls, on the CPI, on ISM manufacturing PMI, the FOMC events, and now it's starting to pick up once again. And I wouldn't be surprised if it continues to accelerate further, given that September, October, usually seasonality-wise, are also not the best months for the market, and volatility is also elevated and is also on its way higher. So this was the last report, as I just went over earlier. We did see energy basically flat, and on a year-over-year basis 1.1%, although last couple reports we've seen negative changes, meaning 2% down each month, and then July was a little bit more on the flat side, and we have seen energy prices roll over quite considerably. Last 2 months in a row we've seen prices come down, so I would not be surprised if energy is lower. In other words, we see deflation for energy month over month in the upcoming report, as it's now trading at $68 a barrel. So we've seen a very significant decline in overall energy prices. Shelter, as according to Apartment List, also coming down, and expectations are very high at 2.6%. So if we come in at 2.6, I think that's going to be a net bullish for the market, in my personal opinion. If you come in anything that's above 2.7, 2.8, or worse, 2.9 or higher, I think that's not going to be very well received by the market, because that is going to once again reiterate the idea that it's becoming more and more difficult for the Federal Reserve to bring inflation down. Really, what I mentioned in my previous updates is it's not so much about bringing inflation down from 9 to 3%. It's really that last mile, the last 1% is really, really difficult. Going from 3 to 2% is the bigger battle for the Federal Reserve than going from 9 to 3, right? 9 to 3 can be done a lot faster and more easier because of supply chain issues getting better. People once again going out there and spending and earning, and there's going to be some reopening of the economy, so it's a lot easier to go from 9 to 3. But that 3 to 2 is what's going to be very, very sticky and a lot more difficult to accomplish over time. So as I said, if we start to accelerate back up, which is the worst case scenario, the Federal Reserve is not going to like that, and the market's not going to like that, because then we could start to backpedal on those 25 basis point rate cut. So really what we want to see is as low inflation as possibly we could, like the lowest reading possible from this inflation report. Lower the better is what the market's going to be looking for, in my opinion, because that is going to reiterate the possibility that the soft landing is still possible, that inflation is indeed coming down, and the Federal Reserve is ready to cut interest rates, albeit a little bit even more aggressively, because inflation is coming down to their target. Now, a few more things that I want to break down in this update very, very quickly that we are going to go over. The first thing, of course, is going to be the September seasonality, as we've already discussed. So I really want everyone to be prepared for another volatility spike. If you do see some in the next couple weeks here, with the inverse correlation, there is a possibility the markets come down further, as we've already discussed some of the very important levels on the technical side for both S&P and NASDAQ. But I'm prepared for volatility to get back up to 25 or even possibly up to 30, considering how much it's already up in the month of September so far, right? So if you come over to VIX, come over to the monthly time frame, this right here is how we are doing, 49% higher in the month of September. In the past, again, we've seen the median values to be much, much higher at 24, 25, for volatility, and we've seen much higher levels of close for the VIX as well. This right here is, again, something from Charlie Bilio, as I mentioned before. As part of the September warning, the price to sales multiple for S&P continues to be at very elevated levels, trading at almost at 2 times more than the actual average or median value, 1.56 times sales, versus the level that we are now at 2.93, although we might be a little bit lower considering the 4.5% sellout that we witnessed for the S&P in the first week of September. And then finally, it all boils down to whether we see a recession or not, and how fast or slow the rate cutting cycle is going to be from the Federal Reserve, because elections right around the corner for the US as well. So every time we have seen recessions, the markets have stalled. We have seen brutal selling pressures and a bigger bear market and a longer bear market for the S&P 500. So it's really going to come down to whether we get into a recession or not. That's really been the big question. That's been the hundreds of billions of dollars worth of question. And NBER, the National Bureau of Economic Research, is really going to be the agency or the government agency that's going to declare whether we are in a recession or not. And this right here is going to be the overall performance. As you can see, if we don't see a recession, the markets tend to actually do a lot better, post Fed cutting cycles that begin. And if you do see that recession play into that story, that growth story, then of course the market stall, worse, actually start coming down. And a lot of that's also going to be dependent on whether we get a faster cutting cycle or a slow cutting cycle. Now, there's actually a very interesting sort of observation from one of the members on YouTube, commented that wouldn't fast cutting cycle be a little bit more being proactive and avoiding a recession in the first place? Well, no, because the thing is that if the Federal Reserve actually indicates a faster cutting cycle, the market doesn't see that the Federal Reserve is doing so to avoid a recession. The market sees the Federal Reserve is doing that to essentially, they're indicating a recession, right? That's what that means, because yes, they may be doing that to avoid it, but they're also doing it because they're too late, right? So that's what the market kind of focuses on. It doesn't focus on the fact that yes, they're cutting rates too fast to avoid a recession. They focuses on the fact that they're cutting rates too fast because they're too late, and we may already be in a recession, right? So there might already be economic contractions. So that's what the market kind of focuses more on, and that's why we tend to see a bigger sell-off if the Federal Reserve out of nowhere surprises the market with a bigger rate cut and a faster cutting cycle, as opposed to a more slow and calm and steady cutting cycle. That means things are normal, things are stable, and the Federal Reserve does not see any type of panic brewing in the economy, and that's why they're comfortable with a slow and steady cutting cycle. So those are some things to keep in mind. Let me know your thoughts down in the comment section below for inflation numbers. As we already know, the liquidity is coming off from the balance sheet. However, it's possible that we start swinging back to the upside because of the global liquidity index, as we are expected to increase once again with these rate cuts, and the Federal Reserve also making adjustments to their mortgage-backed securities and treasury bond portfolio, as we have continued to kind of taper off. And finally, coming over to the MoneyVest dashboard, this is where the focus is going to be for next week. Index rating at 3.39 right now. We've got still well over 58 to 66% of stocks rating above their moving averages, but the lower we drop down to, the better the risk reward is going to be. So right now we're yellow and green, but the more green we see on the MoneyVest dashboard, the better the risk reward is going to be. So please, please, please tune in to these videos or join our Discord. Get those updates, because I really don't want anyone to miss out on those opportunities that the markets may give us in the future, considering that there is significant selling pressure here. We're down almost 5% from all-time highs. And again, even from a technical standpoint, we continue to see a lot of weakness in the markets. So hope you all enjoyed this video and a complete update on the upcoming week here. Inflation is going to be front and center, and we'll be live to cover all these reports and all the data points. So make sure that you drop a like and subscribe to the channel. Link's going to be down below if you're interested in joining us, and of course getting access to all the members only updates, videos, members only private videos, Discord alerts. I will be selling options on Nvidia, so we'll see how that goes. And as always, happy investing. I'll see you all in the next video.